Can you dim the lights?
We are thinking. Hello? This is the German Coast Guard. We're thinking. What are you thinking about?
Yeah, that's it. You can move to the presentation. So I like to play this little clip at the beginning of most of my presentations. A, because I don't have an accent, obviously. And then B, because it refers to language, right? So language is a tricky thing, and there's going to be, for most of you guys, a lot of new terms today that you're trying to understand that you might have not heard about before and or heard about in different contexts. So it's important to learn this if you want to be part of a future discussion in this particular space. So when I was first asked to speak about the topic, I actually was supposed to speak about Bitcoin, I believe, and my response was, hey, can we make it about blockchain instead, because Bitcoin is really just one application of the blockchain in general. Anyway, just a little bit about myself. As you can hear, I'm originally from Germany. I was a software developer in the 80s and then decided to become a lawyer instead. But I haven't been a lawyer since February 27th, 2000, when we sold our internet service provider. So ended up being general counsel for a very large internet service provider. And we were lucky enough to sell the company 6 weeks before NASDAQ hit its all-time high, which allowed me then to move to the United States and became chief operating officer for a venture fund. And we were dealing with virtual currencies back in 2000 already. We had investments in multi-massive online player games, and I don't think there's probably too many gamers in the room, but this is where a lot of this virtual currency paradigm really started, if you will. So I chose the subtitle, The Internet of Value Exchange, and then after I came up with it, I Googled it and found out that Deloitte already came up with it before me. So I apologize for stealing that. Didn't know that. Okay, so a little bit about the internet and blockchains as a new paradigm. So when we built the internet the first time around, we ended up building it highly decentralized, which is kind of symbolized by this little dot here. Presently, it's sort of decentralized, but really, who has more than the choice of 2 internet service providers in the room, right? Probably very few, if any, of you guys in the room. And then also, how many times a day do you use Google and or Facebook versus any other search engine? A few years ago, Google went down for a day. Most people might not know this. 40% of the internet, overall of the internet traffic, dropped off that particular day. So it tells you a little bit about centralization. So what we built back then was really not the internet and World Wide Web. We really built the commercial web. So the way I always like to phrase this, with blockchain we now have the opportunity to actually build the World Wide Web that's decentralized, where you have more than one filter for all the content on there. So what do we have next? So, and as we will be talking about virtual currencies, so let's talk a little bit about the state of money. I assume everybody knows the history of our money, like that we used to have a gold standard, now we don't have one anymore, and most nations in the world issue what's called fiat currencies. John, you got a question? So, which is really money by decree. I declare that this is legal tender, and that's why we're using it. And then it's supposed to mainly function as a medium of exchange, you all know that, a unit of account, and a store of value. So, oops, we jump one. So in October 2008, some element called Satoshi Nakamoto published a white paper, and you probably have heard versions of that story, but these are actual sentences from this white paper. It's only 9 pages long, really. So it says, it proposes a peer-to-peer electronic cash system. So a purely peer-to-peer version of electronic cash, he says, would allow online payments to be sent directly from one party to another without going through a financial institution. Digital signatures provide part of the solution, but the main benefits are lost if a trusted third party, again, that's the financial institution, is still required to prevent double spending, the typical double spend problem. The network timestamps transactions by hashing them into an ongoing chain. So that's the blockchain we'll be talking about. So there's one new paradigm here and a lot of old ones. So as I mentioned earlier, virtual currencies existed for decades. Cryptocurrencies existed before too. So what he or they, one doesn't know, is proposing is to combine those elements and store the transactions on a distributed ledger. So the central elements that you need to focus on is that there's no central authority. Typically, blockchains are open source, not all of them, we'll talk about it. You have a shared records. Shared means you can actually look at every single transaction right now that happened on Bitcoin, for example. Online, you will find a transaction record of every single transaction. Every node on the blockchain carries every single record from day one. The records that are kept are immutable, timestamped, and hashed. So what that means is, once a record gets created, every following record is based on that record, integrated into that record. So for anybody to make changes to this blockchain, it would require the entire hash power of that network to undo that transaction. So then thirdly, and that's kind of an element of game theory, anybody know what proof of work is? No, okay. So in order for a transaction to be created, someone needs to actually run a computer, right? And it's a very hefty processing requirement. And so that person or that entity that's creating that hash is rewarded with a token, him or herself, for doing that work. So that is the proof of work in the system. So this is how a block could be visualized. So every next block has parts of the previous block integrated. So this is all very technical. We don't have to talk about for a long time. I can get back to that later on. I just want you to have a basic visual of this. So initially, every miner was rewarded with 50 Bitcoins. You probably all know how much a Bitcoin is today. It's around $15,000, $16,000. So in today's valuation, it would be about $860,000 for that. Every 210,000 blocks, this amount gets halved. So currently it's at 12.5 Bitcoins, which is about $190,000 based on this morning's valuation. And about every 10 minutes, a new block gets created. A block has a bunch of transactions. It's not just one transaction, but it's a bunch of transactions being crammed into this block, being made immutable. At the current rate, we are creating about 1,800 new Bitcoins a day, and the overall amount of Bitcoins is limited to 21 million in total, out of which a good portion is already lost. Because if you own a Bitcoin, the only way for you to move it is you have a private key. If you lose this private key, there's no recovery for that. Once it's gone, you'll be unable to ever access those funds. So, anybody have heard of forking? Or let me go backwards. I forgot to do what I usually do at the beginning, which is my audience participation part. Who in the room owns any cryptocurrency? Stand up. 1, 2, 3, 4. Okay, so not too many. All right, so you guys probably know what forking is. Did you hold cryptocurrency at any point in time when it was forking? Okay, so you got an extra amount? Yeah. You did, okay. So as I mentioned earlier, Bitcoin and a lot of the other blockchains are typically open source, meaning they're evolving. So similar to Linux, where you got different flavors of the operating system that are continuously improving, adapting to new hardware, Bitcoin itself is evolving too. However, the way that Bitcoin evolves includes the people that work not only on the code, but work on transacting on the blockchain itself, creating the records. So they get to vote. That means even though the majority of developers, let's say, pushes out a new code bases in order for these mining to occur, the miners can decide not to adopt the code. If a significant portion of those miners does not adopt the code, no change to the code is being made. If a significant portion, but not an overwhelming amount, I think it's 95% if I remember correctly, is adopting the new code, a fork occurs. So all of a sudden, besides just having one Bitcoin, you get a new flavor of Bitcoin. Currently, we have two other flavors of Bitcoin. One's called Bitcoin Cash, and one's called Bitcoin Gold. As you can see by those numbers, the Bitcoin, the main chain, which will always be called Bitcoin, has a market cap of about 255 billion. So a single Bitcoin was worth 15,000 some dollars this morning. Bitcoin Cash, on the other hand, 2,400, and Bitcoin Gold only $243 per coin. So Bitcoin is semi-useful, means most people that deal with cryptocurrencies refer to Bitcoin as the gold of the system. It's very expensive to transact right now. So if you wanted to move $10 around, you will move $10 in crypto around, you will probably end up spending more in actual transaction costs at the moment, often $15, sometimes even more. Unlike transacting with other currencies, and depending on what medium you use, you have the influence on how much you want to spend for that. So just like in any trading system, you can set the speed of transaction, and you can set the fee you will accept for that transaction. Some wallets, some software will set a default and let you transact based on feasibility, based on current rates. But if you don't do this, you can find yourself in a scenario which I just created on Saturday, where I want to see how low I can go, and the transaction is still not going through. And it's now blocking every following transaction in that particular wallet I was using. So, and because of this, a guy named Vitalik Buterin came around and said, hey, this concept of a blockchain is really great, but it would be good if we could do more with it. If it wasn't just digital cash, like Nakamoto suggested, but if we had what's called a Turing-complete engine on top of a blockchain. So he created Ethereum. You can think of Turing-complete as a general purpose computer. So something that will be able to simulate any other computer. So be able to act as a calculator, will be able to execute programs, etc. So he came up with Ethereum and created the distributed virtual machine. And this will let you create what's called smart contract, which is probably the most important concept to understand about blockchain, specifically for any lawyer in the room. And this is how it works. So you can write a contract as code into the blockchain, and it becomes part of that blockchain, means it becomes immutable. You can change it. You write it, it's sitting there, it's going to do just exactly that, whatever that is. It could be, hey, if you send $1 into that particular smart contract, it's going to send out 1 Ether, or it sends out $1 back, or $1.10, whatever you write or the programmer writes into that contract. So this does the following. You can have parties that are entirely anonymous. I can decide, okay, I want to devote XYZ resources to this smart contract, and anybody that's meeting my criteria can transact on it. I don't have any say in it. It's all automated. And once the contract gets executed, it becomes immutable. So you're done for. Anybody can audit it, can see, hey, the parties got what they were supposed to do. No lawyer involved, no contract involved. Everything happens in real time. So what this is opening up is probably very apparent. A lot of this will have implications on e-commerce, obviously on record keeping in large forms, on the management of digital rights, and then the most prominent application as of today, specifically on Ethereum, is crowdfunding. And probably everybody has heard that term before, ICO, initial coin offerings. It's a somewhat unfortunate term specifically for every lawyer in the room and lawyers out there, because it obviously relates to initial public offerings. And specifically in the United States, that's not a good thing, because the SEC is really keen on regulating initial public offerings. Hence, most of the projects that did these ICOs try to backpedal from that and say, hey, yeah, we're calling it that, but this is really the marketing event where we push out our new token. And there's a term in this industry we call the utility token. So the idea being is, I'll give you this particular token and it's prepayment for something. So it's prepayment for accessing a network. It resembles a membership. It resembles a gas-like function that will let me transact later. And because you're buying it now, ideally you're going to get it at a discount. I'm proposing you something in a white paper that says, in the future I'm going to distribute solar energy. We already have so many units deployed. And I'm not going to sell you a piece of my company. Instead, I'm selling you a piece of my sales in the future. And I'm going to make it plausible by explaining to you this is how the token works. And this is what we think it might be worth. And people can go out and buy this token right now and most likely trade it later on an exchange, and we'll get to that. There were 235 projects last year that raised $3.7 billion. And a lot has been made in the public press on like the shadiness and the Ponzi schemes in this scheme, in this particular area. This is mostly propaganda, to be honest. So this is how the actual distribution of that quote-unquote money, and we'll define that later, has shaken out. So infrastructure got about a third of all investments. And infrastructure you have to think of as new protocols, as an example, like Ethereum. And secondly, trading investment, finance, payments. A lot of these particular projects actually either have traditional venture capital funding, and this is an additional funding event, and or venture capital came in to exactly do this tokenization event because it makes sense. So these scenarios really raised most of the funds. The top 10 projects in the space really raised about 35% of all funds in the space. And you will see some very big names like Draper, Fisher, Jurvetson, etc. behind those projects. So this is really the part in ICOs you should be focusing on, and not what's typically being promoted in popular newspapers, because they're not really interested in looking at the detailed facts. They're just interested in the hype and the people that lost money. So speaking of that, so if you go back here, you see a prominent example was Tezos, and the way that these projects get listed online is often by the US dollar amounts they raised. However, I'm actually unaware of any ICOs that would accept US dollars. Typically, it's Ethereum and or Bitcoin and or a slew of other cryptocurrencies if the ICO project decides to take those. In the case of Tezos, for example, they only allowed Ethereum, Ether, and Bitcoin to be contributed to their project, which at the closing of the ICO amounted to $232 million. However, they raised this is Bitcoin, this is Ether, they raised this in these two amounts. It's very unlikely that they liquidated these amounts, or at least not a huge portion of these amounts. So let's just, for the sake of math, run the numbers of if they still have exactly these cryptocurrencies in their account. This comes out to about 1.4 billion. One thing that a lot of the ICO projects, when they initially came up on stage and were asking for funds, didn't really consider was that transactions on the blockchain cost money. Someone has to pay for the transaction. On the Ethereum blockchain, which is the most popular blockchain today, this transaction fee is called gas, hence that little gas station sign. And I just picked 3 different times at which I just took a screenshot on my gas meter on my phone to pick transaction costs. So in October, it was 13 cents on average, and November, 7 cents, and then this is from yesterday, 95 cents. So if you go back and listen to some of the speeches that projects were putting out saying, hey, we built something on the Ethereum blockchain, if you evaluate those projects, you got to think through this. It's like, okay, they're proposing to store your personal data on the blockchain, right? And then distribute it for security. So I'm going to place your first name there, your last name there, your social security number in parts there. Those are all transactions. So those transaction costs will add up and will add up fast. So someone would have to pay for that, which means that some of those projects that have been proposed on the Ethereum blockchain are literally infeasible. They're economically not viable. And that's part of blockchain economics, which we go in a little bit further. But let me talk about how to get your crypto out. Right now, there's about 147 exchanges, out of which the top 20 get about 95% of all volume. And I tried to make the top US a little bold. So you got Bittrex, GDEX. GDEX is the actual trading form, the actual trading place of Coinbase. Most people think Coinbase is an exchange, Coinbase is a bank. If you act on Coinbase, you're actually initiating an ACH. That's why it takes 2 to 3 days. So I encourage everybody, though, open up a small trading account and start playing with some Bitcoin, some Ether at this point in time. So what can crypto buy? You can buy your vacation on Expedia right now. They're going through Coinbase right now, so there's an additional fee involved. But hey, if you're a crypto billionaire, why do you care? Same with Amazon. I used to do this in the beginning when I got into the game. There's a little app that lets me buy Amazon gift cards. So I would always put my proceeds in Amazon gift cards until my stored amount on Amazon was so huge that everything that I was buying became free to me in a way. So it was a little game I played on my phone. If you haven't seen them, you will. There's about 15 Bitcoin ATMs in San Diego. Right now, the process is rather cumbersome. It makes you do a lot of hand waving and showing your ID, etc. So if you see people doing the jumping jacks, that's probably some requirement of the Bitcoin ATM. So hopefully that's going to get a little more simpler in the future. One big thing that you probably all have heard of is security. So unlike in a banking scenario, you are typically 100% responsible for the funds, all the funds that you hold. And what a lot of people did in the past, and partially the exchanges were to blame, because exchanges are really not a good paradigm on the blockchain itself, because the blockchain, as we saw, are really a distributed network where exchanges are centralized. So they are preferred target of the hackers out there. It's like, hey, there's a big bounty there. They're storing $100 million US in crypto. I mean, what juicier target can you find? It's immediate cash that you cannot follow back if you can get it, right? So there were a couple of hacks in the beginning, and probably a lot of people heard about the Mt. Gox hack, which was one of the first exchanges, which then went under. FBI went in, took out the Bitcoins that were left. Tim Draper bought them up for $20 million. That was it 20 million? I think so. Anyway, so that Bitcoin is worth about 2 billion right now that he bought there. But what's important to keep in mind is that a Bitcoin and a lot of the other cryptocurrencies are really bearer instruments. So they're digital bearer instruments in the sense of I can give you a $100 note out of my pocket, hand it over to you, I don't have it anymore, you have it. So that's the virtual representation in space, so to speak, of a Bitcoin or an Ether. Once I hand it over, it's gone, right? It's no longer exists in my wallet, only exists in the new owner's wallets. So as long as you keep your wallet connected to the internet, there is a potential threat, which is why there's now a lot of things called cold storage, and they could most likely look like a USB drive, most of them. And you move your funds on there, you disconnect it from the internet, and no one can reach it anymore, just like the $100 note that's sitting in your drawer at home. If you haven't heard it, you can trade Bitcoin futures now since October, also on the largest exchange in the world in Chicago. And this is just a quick slide for market returns for last year. So that's about 5% if you invested in real estate. This is about, I forgot to write a number there. I think it's like 14,000% if you invested in Bitcoin. This is actually an entire separate 1-hour talk I give on the legal environment. I reduced it to one slide. So the legal situation specifically in the United States is very uncertain. That's also the reason why most of the ICOs and recent ICOs actually include the United States entirely. You'll try to go to the ICO page and we'll tell you, hey, sorry, you're coming in with an IP address from the United States. You're not allowed to participate because of your regulators. So the IRS already put out word a while ago that they are intending and are doing taxation of Bitcoin as property. And there was an interesting incident the year after they did this. They looked at Coinbase, and Coinbase at the time had 1.4 million users. And since the IRS declared that Bitcoin is a property, they expected about the same amount of tax returns mentioning Bitcoin, but instead got 4. So that got them a little annoyed, so they subpoenaed Coinbase to hand over all their records. They fought it semi-successfully, and they ended up handing over the records of Coinbase users with a transaction amount larger than $20,000. FinCEN has at various points in time injected themselves into specifically exchanges that were exchanging currencies, and in a way, by doing so and by making certain noises publicly, they wrote law and essentially creating a situation where virtual currency, from their perspective, is money, even though internationally the International Monetary Fund said it's not money, it's not a currency. So unless the situation gets sorted out, there's going to be very little projects happening in the United States. A lot of what I do is just structuring ICOs and digital currency plays that do not involve the United States. And or we have a separate agreement with a PPM where accredited investors just invest beforehand and they don't invest directly in the token per se. I can talk more about that. So a few of the US states have been coming out with legislation, however. So the unfortunate one being New York City. Now in New York City you have to create a BIT license. What that did is a lot of currency issuers simply exclude people from New York City now. That was the effect it had. There's 2 exchanges that decided they want to go through the procedure, but most just avoid New York. Las Vegas, or Nevada to be more accurate, came out with legislation saying, hey, any profits from blockchain activities will be tax-free. Doesn't do anything much today, but it's an interesting announcement to make. And then lastly, Delaware, where I like to incorporate US corporations, has declared, hey, you can now keep a record of your shareholders on the blockchain, which again is progressive, not much happening there, but hopefully in the future there will be. So now back to like the regulators intervening. So a lot of times when these regulators make noises, they pretend, hey, we are protecting the consumer and we don't want people to get involved in money schemes. Like I just pointed out, like because of that, most ICOs specifically exclude US citizens in their entirety. But then also you got to think about it this way. There's, at this point in time, and these are a little bit outdated numbers, but maybe there's like 20, 25 million digital wallets out there. So what that means, there's really only about 10, 15 million people that hold any crypto. And so most of them you can classify as either miners, so those are computer geeks, early adopters, people that bought some Bitcoins early that are now playing with the house's money. But I always say no real consumer were harmed in the process of this ICO, right? So you got to think about it this way. A regulator doesn't act on behalf of the consumer. They don't have an office on K Street, right? So they act on behalf of banks, of the legacy systems, etc. They want to see this regulated. Do we have one more? Yes. Okay. So this is kind of one of my favorite topics, although it has become kind of a stepchild of blockchain, decentralized autonomous organizations. Some of you in the room might have heard of the DAO. The DAO was a failed project, unfortunately kind of hijacking this particular term. So what a decentralized autonomous organization is essentially it doesn't have a fixed ownership. Anybody can join by simply holding that token of that organization. You write a smart contract, you say the purpose. That's why I like to typically refer to it as a for-purpose organization. The purpose of this particular organization is X. So X could be, I provide free energy to the city of Denmark, or I run a free transportation service for people that are under 5 feet high. Whatever you can imagine. And then you assign assets to this and let it run itself. There's no central organization. There doesn't have to be a profit motive. So if you use this paradigm and think forward to where I can buy, my favorite example is a self-driving car, and I assign it to a decentralized autonomous organization. It doesn't belong to me anymore. It belongs to whoever holds token in that. And then I write the purpose in it. Hey, your purpose is not for profit. Your main objective is to take over the market. Your main objective is be always cheaper, be always faster, be always better than everybody else, and multiply. So it's going to be hard for any for-profit organization to address that particular paradigm. So that's one thought I wanted to leave you with. I think that's the last slide. And I'm here for lots of Q&A because I'm thinking there will be some.